We hear about a company's profits all the time, but what does that number really mean? Well, today we're going to break down profitability ratios by following the money on its incredible journey from the very top of a company's books all the way down to the bottom. So you see a headline, right? Company X just hit $1 billion in sales. And that sounds amazing. But here's the thing, that huge number, what they call the top line, it tells you almost nothing about how healthy that business actually is. It's kind of like hearing the starting pistol at a race, but having no clue who actually made it to the finish line. The real story isn't that billion-dollar starting number. It's the journey that money takes inside the company. As it flows through the business, how much of it actually survives each stage? That's the secret that profitability ratios unlock. So let's follow that journey together, step by step. I want you to think of a company's income statement like a giant waterfall. You've got this huge pool of cash at the very top, but as it cascades down, different costs and expenses take a chunk out of it. Our job, as analysts, is to measure what's left at every single level. And here is our map for that journey. We start with net sales. That's the whole pool of money at the top. Then, the first drop takes us down to gross profit, right after we subtract the costs of actually making the stuff they sell. The next drop gets us to operating profit, after we pay for, running the business. And finally, we land at the very bottom, net profit, the famous bottom line. All right, let's start at the top. The very first bite taken out of all that sales money goes to paying for the direct costs of creating the product. This is what we call the cost of goods sold, or COGS. So think about the raw materials, the parts for a new car, or the wages for people on an assembly line. Once you subtract that from your sales, you get your first major number, gross profit. And this leads us straight to our first key metric, the gross profit ratio. Now, this has nothing to do with marketing budgets or CEO salaries. It's purely about one thing. How efficiently can the company make what it sells? It's a raw measure of its core production efficiency. The formula itself is really asking a simple but super powerful question. You take that gross profit, you divide it by the net sales, and what you get tells you this. For every single dollar of sales, how many cents are left over after you've paid to make the product itself? It tells you if the company is good at managing its material and labor costs. Simple as that. And this is why it's so important. Think of it like a diagnostic tool for a doctor. If this ratio starts to fall, that's a huge red flag. It means one of two things is happening. Either their raw material costs are going up, or they're being forced to slash their prices to compete. But here's the cool part. What if this ratio is holding steady, but the company's final profit is shrinking? Well, that tells you the problem isn't in production. The problem is hiding somewhere further down the waterfall. Okay, on to the next drop in our waterfall. So after you've paid for making the product, a company has to pay for literally everything else it takes to run the business. We're talking marketing, admin staff, rent, all those operating expenses. This gets us to the next level of profit, and it's a number that tells us if the core business engine is actually profitable. Now, this next part is where things can get a little confusing because you're going to hear two acronyms that sound almost the same, EBIT and EBITDA. But trust me, they tell very different stories. The key difference, the great divider between them, is how they handle non-cash expenses, specifically the accounting cost for the general wear and tear on assets, which we call depreciation and amortization. And this table just lays out the difference perfectly. So EBIT, which stands for earnings before interest and tax, includes depreciation. It's an accounting profit measure. It's asking, hey, is the business profitable after we account for the cost of maintaining all our stuff? On the other hand, EBITDA, earnings before interest, tax, depreciation, and amortization, strips those costs out. It's more of a proxy for cash flow. It asks, how much actual cash is the core business generating? Now, for a waterfall journey, we're going to focus on EBIT to calculate the operating profit ratio. And why is that? Well, because it gives us the purest measure of a business's actual performance. It completely ignores how the company's financed, that's the interest, and what the government is charging, that's the tax. This lets you make a really clean apples-to-apples comparison between different companies. So this ratio takes that pure operating profit, our EBIT, and divides it by net sales. And it answers the big question. After paying for both the product and the operations, how much profit does each dollar of sales generate? This is really the ultimate test of how efficient a business model is. We are getting so close to the bottom of the waterfall. We've figured out our operating profit, but there are two more parties that need to get their cut: the lenders who charge interest on any debt, and of course the government, which takes its taxes. After these final deductions, we finally arrive at the bottom line. And this brings us to the net profit ratio. You can think of this as the final scorecard. It measures what percentage of all that revenue at the top is left as pure profit after every single expense, production, operations, interest, and taxes has been paid out. The formula is as simple as it gets. You just take the profit after tax, or PAT, and divide it by the net sales. This number shows you the ultimate efficiency of the entire company. For every dollar in sales, this is the number of cents that truly, actually end up as profit. And here's where comparing these ratios becomes a superpower. Let's say a company has a really strong operating profit ratio, but its net profit ratio is weak. What does that tell you? It tells you the core business is healthy, but it's being dragged down by either huge debt payments or a really heavy tax bill. And that, right there, is a crucial insight. Okay, so the company has a final profit. Great. But what does that actually mean for the people who own the company, the shareholders? The very last part of our journey looks at profitability from their point of view. This brings us to a really famous metric, earnings per share, or EPS. It's actually beautifully simple. You take the total net profit and you just divide it by the total number of common shares out there. It tells you exactly how much profit belongs to each individual slice of ownership in the company. Now, investors absolutely love to see a rising EPS. It's often seen as the ultimate sign that a company is doing great. But here's a critical question you have to ask. Can that number be misleading? Can EPS go up without the company actually becoming more profitable? And the answer is absolutely yes. And this is such a critical distinction to get. EPS can go up for two very different reasons. The first one is the good one, the one you want to see. The company's total profits are genuinely growing. But the second reason is more like financial engineering. A company can use its cash to buy back its own shares from the market. This reduces the number of shares in circulation, which automatically pushes the EPS number up, even if total profits haven't budged 1 single cent. Okay, wow, we've traveled all the way down that profit waterfall, from the top-line sales number to the bottom-line profit that belongs to shareholders. So let's just take a moment to put it all together in one clear, simple picture. Think of this slide right here as your ultimate cheat sheet. Each level of profit we've talked about answers a really specific question. Gross profit, which we measure with the gross profit ratio, tells you all about production efficiency. Then there's EBIT, measured by the operating profit ratio, which is all about the core business efficiency. And finally, PAT, or profit after tax, measured by the net profit ratio, shows you the overall profitability of the entire operation. Each ratio is a different tool for looking at a different part of the business. And we'll end on this classic piece of wisdom. It's a fantastic reminder that while some metrics like EBITDA can look impressive, that's vanity. It's the real, hard accounting profit that shows a business's sanity. And at the end of the day, it's the actual cash in the bank that is reality. So the next time you see a big, flashy sales number, remember to ask yourself, what really happened on the journey down the waterfall?